Let's bring in JP Morgan senior airline analyst Jamie Baker. Jamie, good to see you. Thanks so much for joining us. What was your key takeaway from Delta's numbers and earnings call?
Look, we were pleased with Ed's performance, on your show earlier this morning, and certainly with the guide. Unfortunately, it was not as well received by some of my competitors, largely on the basis of costs. You'd have to ask them onto your show to explain, or give some granularity on that. But the cost guide that Delta dropped was, spot on with our forecast. We'd expect overnight that consensus of around 30 cents goes up to 45 cents. It's the first time Delta has actually raised relative to consensus since the fourth quarter of 2019. So we have a positive view on today's report.
The whole group, Jamie, has had a rough go lately. It's almost in a bear market, down like 19% or so from the recent highs. Is that on concerns about the Delta variant eventually hurting travel demand as it spreads in this country, or cost pressures?
Look,
what is it?
That's part of it. I do think the reopening trade, at least for airline stocks, got a little ahead of itself. Some recent CapEx and capacity guides have created some consternation for investors. The Delta variant, a sluggish pace of international reopening. But what I would say is that these sort of corrections in the past, 20% short-term corrections, have largely proved cathartic. It's painful for current owners, but this is usually the kind of correction from which, we can look for an inflection point and new investors have a better opportunity to get in.
Jamie, to what extent are people focusing really clearly on the debt levels of some of these names in a way that over the last year have been a bit more binary? Things are reopening, stocks are going to rally kind of regardless.
Well, look, I think it was refreshing that probably the majority of equity analysts on Delta's call today did inquire on that topic and the plans for balance sheet repair and how the company is going to, balance that mandate against other priorities. So I think it's absolutely a focus, but it's manageable. And the fact of the matter is we expect the industry to emerge with ex-fuel costs that are sufficiently lower than future interest costs or the incremental interest costs. So we actually see a path for the industry in the next 3 to 4 years to generate higher margins than it generated pre-COVID.
Shepard Smith here. Thanks for watching CNBC on YouTube.